The month of March was a positive month for risk assets, with the MSCI World rallying significantly, especially since the Fed announced its intention to be dovish. Mid-February, the bottom in the MSCI World was reached when Janet Yellen delivered a speech at the Congress. Hedge funds in this environment were supported by the risk environment. They were up in March, 0.6%. They remain nonetheless in negative territory year to date. However, hedge funds outperform risk assets on a risk-adjusted basis, considering the very high volatility of equities over the recent quarters. On the contrary, fixed income and government bonds in particular continue to deliver positive returns in March and during the first quarter of the year. However, the very stretched valuations of the asset class do not suggest to take aggressive positions on fixed income. As of early April, the 10-year bund yield trades close to zero, and 10-year Japanese government bond yields are in negative territory. With regards to hedge fund strategies, CTAs suffered in March because of the supportive risk environment, but remain in positive territory year to date as a result of the strong gains posted in January and February. On the contrary, the strategies with more market directionality were up in March. Fixed income and in particular long-short credit was up. Event-driven delivered positive returns as well, and long-short equity was up 1% in March. Year to date, the picture is quite different compared to the month of March because of these two regimes: very bearish January and February, supporting CTAs, very bullish in March, supporting strategies with more directionality. Going forward, we note that the bullish market sentiment has faded early April, and hedge funds' defensive positioning highlighted by the median equity beta on the Lyxor platform, which stands at 15%, suggesting a defensive positioning, is likely to support the asset class in a turbulent market environment. The usual equity beta has been around 30% over time, and currently at 15%, it demonstrates the ability of the asset class to provide protection in such market conditions. With regards to investment recommendations, we continue to be overweight merger arbitrage. The strategy has demonstrated its ability to navigate across all market regimes. It was quite resilient when markets were down in January and February, and up when markets rallied in March. We are also overweight long-short equity managers with a variable bias, which can navigate more easily these changing market conditions. And we are also overweight global macro strategies, which have a relative value focus. Meanwhile, we are neutral on CTAs, since their long fixed income positions are a source of risk, considering the very low bond yields. And finally, we are underweight special situations managers within the event-driven space as a result of their very high market directionality, which does not seem to be appropriate in the current market conditions.